Hi, today we're going to have a look at money markets, particularly at how they work. Now, first of all, I'd like to just spend 20 or 30 seconds thinking about what a money market is. Work from your own understanding of economics, what you think a money market is. I'd like to pause for 30 seconds, starting now. Okay, so you've unpaused. Now what we're going to do is we're going to have a little look at how money markets work and the different types of them. Now there are two specific types of markets that we're going to focus on. We're going to look at the money and the capital markets. We will look at a third as well. We'll also have a look at the foreign exchange market as well today. But first of all, I'd like to just have a look at these two. So the money and the capital markets. I'd like to spend 10 minutes just researching online the difference between the two. I'd like you to make notes, make sure you very accurately identify what the key differences between the two are. So I reckon 10 minutes to do this. In a second I'll just press pause and then come back when you complete this task. Okay, pause. Okay, so you've looked at these two types of market. Hopefully you've come up with some of the ideas that we're going to look at on the following pages. So the money market is more of a short-term thing. It's more about financing for businesses and households. So if you want to start a small business, or perhaps you want to take out a loan to purchase a car, so it's usually smaller loans like that. It may even be much smaller loans than a car. It might be something like purchasing a washing machine or a dishwasher. Usually the loan is 12 months, so we're looking at overdrafts, we're looking at temporary small loans, things like that, which you know you're going to pay back fairly quickly. It also includes the lending between banks. It's one of the biggest things with banks. You think banks make a lot of money from lending us money. They make more money from loaning one another money, because obviously this can be passed and repaid quite quickly. And obviously this creates liquidity, which liquidity is the ease in which money can be moved around and the ease in which you can get hold of money. So banks will often lend to each other. It also includes the movement of money between government departments. So treasury bills being paid off, money being lent from one department to another, money coming out of the government's fiscal budget, which is usually on a 12-month cycle. So as long as the money is returned and used in that period of time, that tends to be classed as the money market. And hopefully you find out about the capital market is more medium to longer term sources of finance. So these can be large scale borrowings, particularly issues of shares and bonds within firms. So the purchasing of ownership of businesses in order to fund long-term borrowing and long-term development and growth. Government does this as well. They launch their own bonds, which are essentially government IOUs and loans, which government actually issues in order to finance borrowing and finance growth through there. So this includes raising finance by the government. So the government actually has to find money from elsewhere. Your taxes are not enough. So the government takes out loans against what we call bonds, which is something we'll look at a little bit later. And the third type, I didn't ask you to look at this, was the foreign exchange market. We have looked at this briefly last year. So this is all about the buying and selling of currency. So the idea is speculators purchase a certain currency on the hope that when it's currently at low value, it's going to rise. So it might be, for instance, Tunisia is a good example. The currency in Tunisia plummeted about 4 years ago when there was a terrorist attack. It was a very popular tourist resort. A lot of Westerners were killed on an attack on a beach, and the government declared it essentially an unsafe place to go, so the currency plummeted rapidly. It's been recently removed from the unsafe countries to travel to list, so therefore purchasing of Tunisian currency has actually increased rapidly, as speculators are purchasing it, hoping in the next 18 months or so some holiday usage will increase there, so therefore they'll be able to sell back the currency and make a profit from there. We see this happen quite a lot, basically because most currencies are not fixed. They are what we call floating exchange rates, so they are affected by the laws of supply and demand. So as demand goes up, prices go up, and depending on whether or not supply is fixed, that'll have a bigger or smaller impact on it. So they're the three sort of like main markets we look at: the money market, capital market, and foreign exchange markets. We will look at these in much more detail as well as we go through. They make a significant impact on what we look at with regards to the whole world's economy. Now I've got a second task for you. You can either use your phone, or in this case, because you'll be doing it on your own without me here today, you will be sat at a computer, so I would like to have a go at these. So these are 4 key terms of things we're going to look at today and for next week as well. So I would like you to do a quick bit of research, just lay it out like this in a table. So I want you to research to find out what we mean by shares, corporate bonds, government bonds, what we mean by coupon, and we're not talking about a 20% discount from Tesco. You want to link this to these kind of 4 key definitions. So another 15 minutes or so, you will have to do some research online. Press pause now. Okay, so you're back, so hopefully you'll come up with something like this. Now, what I'm going to show you is the actual definitions of what we should be looking at. So shares, undated financial assets sold initially by a company to raise financial capital. So basically when you sell part of the ownership of the business off in order to raise money, in order to hopefully grow the business. So you might be looking to invest in a new factory. So perhaps you have to sell off 5% of the business in order to raise the funding for this. Now corporate bonds, these are debt security issued by a company and sold as new issues to people who lend long term to the company. It can be resold second hand on a stock exchange. Essentially these are IOUs. So if a company, for instance, borrows some money off another organisation, so they will essentially give you an IOU, and we owe you £1 million, but the owner of the IOU can actually sell it on the stock market. So let's say the value of the company is growing, some speculator might want to buy this debt because they will be able to then maybe glean more money out of it in the long term. So we see these various trades going on. The government bonds are pretty much the same kind of things as gilt-edged securities, essentially the same thing, but they are bonds owned by the government. So it's money, IOUs essentially with government issues. Then the coupon is what we call the fixed interest payment, which is linked into the bonds itself. So it's essentially the value of the bond and what kind of return you'll expect from it. Now we're going to have a look at how these bonds work. Now, there are lots of different interest rates in the UK economy: saving rates, bank mortgage lending rates, credit cards, payday loans, corporate and government bonds. Everything has a different level of interest attached to it. Base rate is currently about 0.5%, so that's the basic lending rate from the Bank of England. The average 2-year fixed rate mortgage is running about 2%, so the banks are borrowing money from the Bank of England. The banks are paying the Bank of England 0.5% interest, so they whack on a bit of interest themselves when they loan the money out to us to make their money. The average £10,000 unsecured loan is running at around about 5% interest rate, so you'd be paying £5,000 back on that. And saving deposits are at like all-time low, 1.5%. That's pretty much the best rate you're going to get out there in the market. So any money you put in your bank, you're only going to earn 1.5% on it. Theoretically, the idea behind that is that it encourages people to spend their money rather than saving it. If we spend the money, theoretically the economy grows forever with demand issues. Now, what we're going to spend a bit of time is looking at these bonds. So we looked at what bonds were before, but we know they pay a fixed annual set of interest. This interest rate is called the coupon. So whatever currency it's being paid at, it will be linked very much to that. So what we see here is when the bond prices are rising, the yield will fall. When the bond prices are falling, the yield will rise. So we're seeing a very inverse relationship between the market price. And we'll have a look at what this means now. The example I've got here is a 10-year government bond issued. So it's a bond which will last 10 years. So if you lend the government money, you'll actually be receiving 10 years worth of payments on top of that. So if it has a value of £5,000 and the coupon rate is set at a fixed interest rate of £200, what we want to have a look at is what kind of return we are expecting percentage-wise. So the yield is a simple formula. Basically, you look at the interest on the bond divided by the actual market price of a bond times 100 to make the percentage. So a bond trades at 5,000 and the yield is going to be 4% because you've got your interest of fixed interest of 200, so you're always guaranteed to get that. Divide that by the actual initial price of it, times by 100 gives you a 4% return. So what it's saying is every single year you will make 4% back on that bond, because you will get your full £5,000 back at the end, but every year, essentially, for lending the government £5,000, you'll be given £200 a year for about 10 years, and then you'll get your full £5,000 back at the end. So here we go, we've got the same example here of a £5,000 bond with a £200 coupon, so we have that same 4% calculation there. What we have to think about is what happens if the market price rises for this bond. Say there's like a great deal of demand for investors. So the price of bond goes up to £5,500. Now theoretically we think, wow, it's a bond's more valuable, so we're going to make more money from it. But the interest rate actually stays fixed at £200 because that's the agreement on there. So the yield changes. So we go 200 divided by 5,500 times 100. Your yield's actually down at 3.64%. So you're suddenly saying, oh well, the value of my bond has gone up, but I'm earning less money per year on it. So you'd be thinking, well, why would I want to do this? So we see the difference with this 3.64%. We're not making as much as we want. And this is not necessarily our fault, because our bond is, we lent it at 5,000, but it's now actually gone up to 5,500 in value. So we start to see an inverse relationship between this. Whereas on the other side, if we have the same situation again, £5,000 bond, £200 coupon price, 4% interest, 4% yield, sorry, if we start to see a fall in the price, or the value, sorry, of the bond itself, maybe because there's a less speculation or the investors are a bit more nervous, we start to see a drop. So let's say the price falls to 4,300, the interest stays at £200, it has to, therefore 200 divided by 4,300 it gives us a yield of 4.65%, so theoretically we're actually making more money from it. So the bond is of a lower value, so therefore that's the rating. We still paid 5,000. We've still actually loaned the government £5,000. What the market's saying is that £5,000 is only worth 4,300 now. So the government is still having to give you the £200. So they're actually giving you 4.65%. So it looks like a better value, but you still receive your full amount on the 5,000. So over a period of time, you'll actually work out slightly better as an investment. These bonds don't really reflect the natural government run, so we'll see across Europe very, very different rates. If you want to pause at any time just to study this, you can do. And if you want to then carry on, just press play whenever you want. Okay, so hopefully you've had a quick look at this. You can see the Greek yield is really high, basically because the government's debt is a higher risk, basically because the Greek economy was shocking in 2016. So lending money to the government was getting a bond from the government was actually more risky because it wasn't necessarily the fact that you were going to get your money back. Okay, so I'd like to have a go at two tasks. So these are going to be working out the yield on two different bonds. So what I would say is give yourself 5-10 minutes, or maybe 5. Have a go at the two calculations. You can go backwards in the video if you need to. But I would say in a minute pause and then only unpause it when you want to have a look at the worked examples. So if you want to, pause now. Okay, so you should have had to go at it by now. The first one, there is the result for it. If you go through the process of it, you've got a 5% yield. And there's the second one. We work out what the current actual price is worth and the value of our actual yield. So, moving on again. Now, excuse me, there is a big role for financial markets in the whole economy. As you can see, the idea behind it is that it has all these different impacts. So the idea is to facilitate savings by business and households, to lend to business and individuals, to facilitate the exchange of goods and services, to provide forward markets and currencies and commodities, and provide a market for equities. Basically, the idea is to get the markets working. So there's a level of government intervention in order to facilitate economic growth and development. It's worth making a note of these 5 key things because we will be coming back to this in a later lesson. Right, now to finish off, this is in preparation for next week. Next week we're going to spend a bit of time looking at commercial investment banking. So we're actually going to look at the banking industry itself. So what I'd like to do is you are going to do some research on these 2 different types of bank. So I'd essentially like you to create a table. So split your A4 page right down the middle. One side commercial banks, one side investment banks. And I'd like you to review how these 2 different types of banks work, what kind of services they offer, and also any significant differences between the 2 and how they work and what they do. Your following task will be to also have a look at what the government have done to regulate these 2 types of banks. Up until a couple of years ago, any high street bank could basically be both commercial and investment. What I'd like to have a look at is why the government has set regulation that banks must split their commercial arm and their investment arm. So you can have someone like Lloyds, for instance. They can have both a commercial and investment banking, but they must not interact with one another. And I'd like you to have a look at why the government brought in this regulation that commercial and investment arms of the same bank must be split. I would like you to bring these notes with you to next week's lesson, because this is going to be really, really important for what we do and how we develop and what we look at within the commercial and the investment banking system. Okay, thanks very much. I'll hopefully see you all soon. Goodbye.